Hey there, good afternoon. The temperatures are falling. Will inflation be next? Let's talk about let's talk about that today, as well as a number of other aspects of the housing and economic markets. A lot of data going on last week, this week. It's been a volatile season in the housing and economic markets, and we're going to talk about that today. So thank you so much for joining me on SRT Live. I am your host, Sean Richard, with the Sean Richard Mortgage team here at Guaranteed Rate. All right, so let's dive in. Let's talk about the information that we got last week. So the big blockbuster information that everybody was talking about was the Fed rate decision. So in case you were living under a rock, the Fed increased the Fed funds rate by 0.75% or 75 basis points. So this brought the Fed funds target rate to 3.25 to 3.5, and that had an impact across the economy. Now, remember, the Fed funds rate is short-term lending. It's actually overnight bank-to-bank lending rates, so it impacts short-term lending like auto loans, like credit cards, things of that nature. It does not have a direct impact on mortgage rates. So what does this mean? Why are they doing it? Fed is consistently increasing the Fed funds rate to aggressively combat inflation because we've been running at 40-year highs. We've got to bring that down. We also got existing home sales. Really important for you real estate agents out there. Month over month, we saw a decrease of 0.4% to an annualized pace of 4.8 million. Now, this represents a 19.9% year-over-year reduction in home sales. I think we can all agree that the rising prices and rising rate environment has definitely slowed demand some, and we're seeing that reflect in existing home sales. We also got our jobless claims, as we do every Thursday. So we get initial individuals filing for unemployment for the first time and continuing people renewing their unemployment benefits. So initial claims, we got a reading of 213,000. This is up slightly from the previous week at 208,000. But it did come below expectations of 220,000. So a little bit stronger unemployment claims results than the market was expecting. And on continuing claims side, we saw the same thing. We came in just a hair under the expectation, which was 1.39 million. We came in at 1.379. So about 10,000 below. And this is down from 1.4 million the prior reading or the prior week. So we are continuing to see a relatively strong jobs market in the face of the news that we're seeing companies lay off individuals. So we want to watch this closely as always. Now, the news of today and so far this week, big news today when it comes to housing. We got the Case-Shiller and the FHFA, which is Federal Housing Finance Agency. We got both of their home price indexes. So this is appreciation data. Now, this came in as a huge surprise to the downside. You know, we have been seeing home prices appreciate at a pretty rapid clip. We're expecting that to cool down as we head into the fall and winter months. The Case-Shiller report came in year over year, showing that we're still appreciating nationally at a 16.1%. However, this is down from the 17.9% expectation that analysts were looking for. So we are still appreciating a good clip. We saw that slow down, which is really to be expected with rising prices and rising interest rates. Month over month, Case-Shiller says that we're actually down or negative 0.3%. So pretty close to flat, which can be expected as we head into recessionary times. I don't expect to see any significant declines in home prices, but the data is going to tell us that going forward. Now, this appreciation data is for the month of July. So right as interest rates were peaking in June and staying relatively high through the rest of the summer months. FHFA also has their appreciation data. They came out with an annualized pace of 13.9%. But the big surprise with FHFA was the month over month numbers for the month of July at negative 0.6% appreciation. So losing a little bit of ground there. But I think that what we're likely going to see, my personal opinion, is that we're going to see home prices start to level off for a little bit, and then we're going to see them start to rise again as we get further into the economic conditions that have been created. Now, we also got consumer confidence from the conference board. And so what this is this is a survey that's sent out to 5,000 households, asking 5 questions, gauging consumer confidence. And this came in at a pretty mediocre level, as you would expect with everything that's going on in the economy. We also heard from Jerome Powell, or we're hearing from Jerome Powell today. I don't have his comments just yet, and I'll bring those to you either later in the week or next week. All right, so looking ahead, all of the crazy volatile market moving information that we've got coming up on Wednesday, we are going to hear from Jerome Powell as well. He actually spoke today, speaking again tomorrow. Anytime he opens his mouth, that has the potential to move the market. So we want to pay attention to what he has to say. We're also going to get pending home sales tomorrow, so we can see signed contracts on, pending contracts on existing homes. And then on Thursday, we get the final reading, the third reading for Q2 GDP. We are expecting that to come in negative, which would finalize the fact that we would have 2 consecutive quarters of negative GDP, which is the old school definition of a recession. So it's likely that we are in a recession or we're about to be in one, but don't expect them to actually tell us that for another probably 6 to 18 months. And then also on Thursday, we get our weekly jobless claims. So we'll go over those numbers. On Friday, we're getting PCE, personal consumption expenditure. Now, this is a critical report because this is an inflation report, and this is the Fed's favorite inflation report. So we're going to see where that comes in to see if we're starting to make progress based on the actions that the Fed has been taking with the Fed funds rate. And then also on Friday, we get the University of Michigan Consumer Sentiment Report. It's that's gonna help us gauge how everybody's feeling about the economy and the outlook moving forward. So we've got a lot of things to look forward to, but I want to take the next few minutes and talk about what we're keeping an eye on this week. So as always, I would be remiss if I didn't talk about real estate and housing. So we're watching home sales and housing inventory specifically. We're seeing demand shrink. A lot of that has to do with rising prices, rising interest rates, and so that is curbing demand. We're actually, you heard me say we're down 19.9% year over year on existing home sales for the month of August. Well, July was down 20.1%, and June was down 14.4%. So we saw a spike in that negative downtrend in June, and that's continued into July and August. So we're seeing a slowdown of demand, but we're also seeing an increase in the number of household formations. And if you heard last week, I talked a little bit about this, but right now as a country, we're averaging about 1.6, 1.7 million new household formations on an annual basis. And so you may say, hey, Sean, what's a household formation? So that's anytime a new household is formed. Kids grow up, move out on their own, new household is formed. Individuals get married, move out to their own on their own, new household is formed. Spouses get divorced and create 2 households instead of 1. That is a household formation. So we're seeing 1.6, 1.7 million households formed annually. And just to give you a quick example of how impactful this is. So from 2010 to 2020, we know from economic reports that builders built somewhere in the vicinity of 5 million homes. Okay, 5 million over that 10-year stretch. Conversely, household formations over that same stretch was about 14 million. So to say that we've got an inventory problem is a bit of an understatement. And we're seeing continued household formations at that 1.6, 1.7 million range per year. Why is it a challenge? Well, the challenge is that right now, builders are on pace to put up around 1.5 to 1.6 million homes. So although it's close to the household formations, we're still looking at a small gap, and that gap is widening as those numbers stay apart. Now, we're also seeing current owners opting not to move. We've got current homeowners that are sitting in rates that they refinanced over the last several years down in the high twos, maybe low to mid threes. And they're having a hard time justifying selling to buy less home at a higher rate for more money. And so we've got supply issues that are happening because those homeowners are opting to renovate their current home or to stay put until they find ourselves in a better economic position to be able to make that change. So we've got demand that is shrinking a little bit, but overall staying relatively strong. And then we also have supply that's staying low because of existing homeowners and the inability to build faster than demand. So we're in a scenario where, although we're seeing home prices stabilize and appreciation come down, we're likely to see a pretty robust housing market for the foreseeable future. And I would also say that once interest rates come down, with inflation coming down over the next year to 2 years, it's likely we're going to see demand pick up even more for all of those individuals who might be waiting on the sidelines for that lower rate. Now, if you are one of those individuals waiting for that lower rate, I do want to encourage you to think about a couple of points. Number one, when those rates come back down, demand is going to spike, and we could find ourselves in a position where we're in a hyper competitive market like we had been over the last 9 to 12 months, where buyers are having to bid over list price and they're competing with 5, 10, 15, 20 different offers in order to win a home. So the lower rate comes with drawbacks as well. Additionally, by waiting, you do give up the equity that you would build between now and then. Conversely, if you were to buy even at the higher interest rates, you get to start that equity build. And then once the rates come down, you would have the ability to refinance the lower rate, getting the best of both worlds. Equity build, wealth build, as well as the lower rate with a refinance down the road. So just something to consider. Now, the other things that we're watching is inflation, always in front and center. We've got that big personal consumption expenditure report coming out on Friday. We want to see a trend. The Fed said 1 month does not make a trend. So we want to see a couple of months moving in the downward direction. So that way we can have confidence that the Fed is going to start adjusting their monetary policy instead of being hyper aggressive. The Fed has come out stating that they're going to aggressively combat inflation, regardless of the lagging data, until they see meaningful material change in inflation. So the concern, and my question is the Fed giving enough time for their actions to take effect, or are they pushing forward so aggressively that they're going to end up in a position where they've overcorrected and we're having to try and leverage monetary policy to move back in the opposite direction? So something that important that I'll be watching as we continue forward. The next Fed meeting isn't until November, but they meet in November and December. We are expecting some additional Fed rate hikes in both of those months, depending on the data that comes out with inflation over the next 45 to 60 days. So we want to keep an eye on that. All right, gang. If you're watching on the Powerhouse YouTube channel, thank you so much for joining me. Make sure to smash that subscribe button so that way you can get up to date real estate and economic information right at your fingertips. If you're a real estate agent and you're watching in Powerhouse Facebook group, thank you so much for being part of our amazing community. Love having you there. If there's any questions, don't hesitate to reach out at the contact information here. You're always welcome to leave comments down below. And until next week, I am Sean with the Sean Richard Mortgage Team. Thank you for joining me on SRT Live. Have an incredible rest of your week.